A warm welcome, friends, to this new chapter called Understanding Balance Sheets. It is part of many finance curriculums and especially it is part of CFA Level 1 Financial Statement Analysis. So, a balance sheet has many bifurcations in terms of parts. So, we will look at all these bifurcations, all these divisions, what they mean, and how do we record them and how do we account for them. So starting with the first thing, let's look at a balance sheet first. So here we have the balance sheet of 2024 for TCS. You can see here, friends, there is something called asset. Under it, the main two subdivisions are non-current assets and current assets. Then you add them up to get the total assets, right? The total assets here. Now after this, we have equity and liabilities. So we have equity here mentioned, and after that you have liabilities. And like assets, under liabilities, there are two kinds of liabilities, which are non-current liabilities and current liabilities. And there are several bifurcations of non-current and current liabilities thereafter. So we will try to delve deep into the subdivisions of all these terms. For now, we'll start with the overview. So if we have to start with the overview, what better thing to start than assets? So friends, let us try to define assets. Assets are basically what is controlled by the owner, what is owned or controlled by the owner. And this is an accumulation as a result of past activities, and this is going to be the reason, ideally, this is going to be the reason for future inflow of incomes. So let us define it. So assets are what is controlled or owned by the owner, that which is a result of past activities, and ideally, that which is the source of future inflows. Liabilities is more like an opposite or antithesis of assets. So liabilities are basically what is owed by the owner to others, and which is also a result of past activities, and under certain ideal circumstances or under the defined circumstances, they can be the source of future outflows. So liabilities are that which is owed by the owner to others, other entities, that which is a result of past activities, and likely that which is going to be a source of future outflows of income or outflows of cash. Now comes equity. Equity is basically the residual of assets after taking out the liabilities. So equity is the residual of assets after taking out the liabilities. So basically, equity is equal to assets minus liabilities. This implies assets is equal to equity plus liabilities. Now this is the main source of the balancing. So on one side you have assets, and on the other side you have equity and you have liabilities, both exactly matching each other, because equity is basically nothing but A minus L. You take out the liabilities out of the assets, whatever remains you put in equity, and you balance both sides. This is how balance sheet is constructed. Although in our example, what we are seeing is they are written they're stacked one above the other, but the numbers will be exactly the same. If you do equity plus liabilities, you will find that it is coming exactly equal to assets. Let's verify. See here, friends, total assets 121,148. Total equity plus liabilities 121,148. Previous year 119,827. Total assets previous year 119,827. So it is the balance sheet that we are talking about here also, naturally. So friends, when we are writing the balance sheet, it cannot be that we haphazardly write any item anywhere. There are several items that can be defined within the balance sheet, as a part of the balance sheet. So it's not like that you can write anything anywhere and get away with it. It has to be organized in a certain way. So one of the ways to organize the different items under assets, equities and liabilities is basically assessing the nearness to cash. Nearness to cash means we can call it kind of liquidity. Nearness to cash. For example, cash. So it is very much liquid. Then comes marketable securities. Marketable securities. They are also immensely liquid, but they may be overnight, they may be 3 months maturity, they may be 7 days maturity, like that. So they are a little bit away from being instantly liquid. They are not instantly liquid. Then another example can be property, plant and equipment. Property, plant and equipment. Let's say you have a plant of 1000 acres or 10,000 acres. Now you want to liquidate it. How much time should it take? What do you think? It can even take years. So this is far away from cash. This is far away from being liquid. So a basic premise that we use when we are categorizing different items is basically whether they are instantly liquid or instantly liquidable or not. Herein comes the definitions of current and non-current. So anything that is liquidable or going to be liquidated, that is converted into cash within 1 year, or one operating cycle, that is current item. Anything that takes more than this time, that is more than 1 year or more than one operating cycle, is non-current item. Examples of current items, obviously cash, marketable securities, receivables, inventory. Examples of non-current items, property, plant and equipments, debt held to maturity, intangible assets, etc., etc. Now, what is an operating cycle, friends? An operating cycle is basically the time it requires for cash to be invested in the business and for it to come back as cash. So you have put in cash in the business, what time it takes, the minimum time it takes for that cash to return back as cash is called operating cycle, one single operating cycle. So how does this work? Let us look at it a little bit more. You enter cash and you take in raw materials, right? You take in raw materials as inventory, then you create a product, then you sell it. When you sell it, you get the revenue. This revenue is basically coming back of your cash as cash. So this is the entire operating cycle. How much time it takes, that is defined as operating cycle. Generally, for current and non-current definitions, we use 1 year only. That is considered as the standard, but sometimes operating cycle can also be used.